So now let us start with the revision of the topic audit risk. So in this video we are going to particularly discuss about what is audit risk, what are the different components of audit risk, and also what are the risks that require special audit consideration. So let's start. So audit risk means the risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated. So when the company's financial statements are materially misstated and the auditor is giving clean opinion. So when the financial statements are materially misstated, the auditor should give a modified opinion, but he is giving a clean opinion. So it means that he is giving an inappropriate opinion. So this is audit risk. Now what is not included in audit risk? So two things are not included in audit risk. The first one is opinion that the financial statements are materially misstated when they are not, and the other is auditor's business risk. Okay, for example, the company's financial statements do not have any misstatement, they're absolutely perfect, but still the auditor is giving modified opinion, but this is not covered in audit risk. This does not amount to audit risk. Okay, and the second thing is that audit risk does not include the auditor's business risk, such as loss from litigation or adverse publicity. Okay, so these two are never considered a part of audit risk. Now what are the components of audit risk? So there are basically two components of audit risk: risk of middle misstatement and detection risk. Risk of middle misstatement further is further divided into inherent risk and control risk, and detection risk is further divided into sampling risk and non-sampling risk. So sampling risk and non-sampling risk is discussed very much in detail in essay 530. Okay, now let us understand what is inherent risk. So assuming that there are no internal controls, the chances or the susceptibility of account balance or transactions to a misstatement is known as inherent risk. Okay, assuming that there are no internal controls, the company is not devising any internal controls, then what are the susceptibility of the account balance or transactions to a misstatement? That is known as inherent risk. So susceptibility means basically the chances that account balances or transactions are exposed to a misstatement. Now, inherent risk is not same for all accounts balances and transactions. It is never the same for all account balance and transactions. It is higher for some account balance transaction disclosures and it is lower for some. For example, in case of complex calculations, the inherent risk will be higher for some. The account balance or transactions which involve complex calculations, the inherent risk will be higher for those transactions. Next, inherent risk is considered while designing test of control or substantive procedures. Okay, so inherent risk is always considered. So when you're designing test of controls or you're designing substantive procedures, then inherent risk is considered, and it is affected both by external factors and internal factors. External factors like change in law regulation, technical development, and internal factors like management's misunderstanding of the complex accounting procedures or guidance. Okay, so inherent risk can be affected by external factors and it is obviously affected by internal factors as well. So we have completed risk of middle misstatement. The first component is inherent risk. The second component is control risk. Okay, so what is control risk? Control risk is the risk that the middle misstatement in the assertion is not prevented, detected, or corrected on a timely basis by the entity's internal control. So basically, entity has internal control, and this internal control is not preventing, detecting, or correcting the misstatements in the assertions. So why is the internal control not able to do that? Either the internal control is completely missing, or it is not operating effectively, or there is a flaw in the design of internal control. That's the reason it is not able to prevent, detect, or correct the entities prevent, detect, or correct misstatements in the assertions on the timely basis. Okay, so it should be able to do that on a timely basis, but it is not doing. Why it is not doing? Either the controls are completely missing, or they are not operating effectively, or there's a flaw in the design of internal control. Okay, now always remember, control risk and efficiency of the internal control have an inverse relationship. The more better the internal control is, for example, the internal control is functioning very well, then in that case your control risk will be very low. If your internal control is ineffective or it is not functioning well, then in that case your control risk will be high. So so we have covered about control risk. Now remember, inherent risk and control risk are the risk of the entity, and they exist independently of the audit of financial statements. They are not influenced by the auditor. Okay, so even if the auditor does not audit the financial statements, still the inherent risk and control risk will still exist. So they are entities risk, and these are influenced by the entity only. Okay, so who is our client? Our client is the entity. So Inherent risk and control risk are the entity's risk, and they are influenced directly by the client. Okay. Now, we have read in the first chapter, the basics chapter, that there are certain inherent limitations in audit, and that audit risk can never be zero. You can only control the audit risk, but the audit risk cannot be reduced to zero. So, auditor can only assess the risk of middle misstatement. He can assess it, but he cannot increase or decrease the risk of middle misstatement. He can only reduce the risk when acceptably low level. He can only reduce the risk of middle misstatement when acceptably low level. But however, risk of middle misstatement cannot be reduced to zero. So you can see, you can only assess that risk. You cannot increase or decrease it. You cannot reduce it to zero, but you can reduce it to an acceptably low level, to such a low level that is acceptable. So the risk of middle misstatement mainly exists at two levels: financial statement level and assertion level. So what does it mean that risk of middle misstatement exists at financial statement level? It means that the risk of middle misstatement is affecting the entire financial statements. It means that it is affecting many assertions. So it has a pervasive impact because it is affecting the entire financial statement items, all financial statement items. So what is the example for pervasive? For example, over here, if you take a look, for example, the auditor expresses an inappropriate opinion on the going concern assumption. Because the auditor has expressed inappropriate opinion on the going concern assumption, it will result in overvalued assets, omitted liabilities, omitted disclosures. So ultimately, it is affecting all financial statement items. Okay, so this was about risk of middle misstatement at the financial statement level. Now, what about the assertion level? So assertion level means that the risk of middle misstatement is affecting assertions of line items of financial statements. Line item means like revenue. So in revenue, there are list of items. In expense, a list of expenses, like account balances. So how will the auditor respond to this? By nature, extent, and timing of further audit procedures. So it apply further audit procedures. Next, detection risk. So what is the meaning of detection risk? Detection risk means that risk that the auditor's procedure will not be able to detect the middle misstatements. So the auditor is devising certain procedures, he is applying certain procedures, but they are not able to detect the misstatement. They are not able to detect that misstatement. Then that is known as detection risk. So the chance of non-detection of misstatement by auditor's procedure is known as detection risk. So detection risk consists of two elements: sampling risk and non-sampling risk. Okay, so the conclusions which are reached based on the sample may be different from conclusion if the population was tested. So we know that in sampling we test less than 100% of the population. It means that we apply audit procedures to less than 100% of the population, and we project the results thereon to the entire population. So whatever conclusions that you have reached based on sample, they may be different from the conclusion if the whole population was tested. So basically the auditor concludes that here the control risk is low but actually high. The middle misstatement does not exist, but actually it exists. So auditor will conclude based on the sample, he will think that the control risk is low, but actually it is high. Based on the sample, he will think that middle misstatement does not exist, but actually it will exist. So he's basically giving an inappropriate opinion just looking at the sample, which will affect the entire audit effectiveness. So these are the auditor's conclusion over here. The auditor will conclude based on the sample that the control risk is high, but actually it is low. Or based on the sample, he will conclude that the control risk, the middle misstatement exists, but actually there is no middle misstatement. So in this case, there is more work and it will affect his efficiency. So basically, if the auditor will conclude based on that sample without applying it on the entire population, so basically whatever sample he has taken, that is not reliable. Okay, so based on the sample he is concluding, but actually it is not there. So this will affect the efficiency of the auditor. Next, non-sampling risk. So reaching an erroneous conclusion but not because of sampling. So factors not related to sampling. So basically you're reaching an erroneous conclusion, but here the reason is not because of sampling. So what are the factors which are not related to sampling? Not adequate understanding of the entity. So because you didn't understand the entity properly, that's the reason you came to an erroneous conclusion. You're not able to carry out risk assessment procedures properly, There is inadequate audit strategy. There is inadequate audit plan. The audit program is incompetent. There is misapplication of audit procedures. Okay. There is misapplication of audit procedures by the team. So your team is the one that is applying the audit procedures. You didn't train your team properly. Due to lack of training, there is misapplication of audit procedures. there is misinterpretation of test results. So you're not recognizing the significance of an error, or recognizing that there is an error. Basically, if there is an error, you're not recognizing, or basically you're not recognizing the significance of that error. There is poor quality audit management. There is lack of direction, supervision and review. There is lack of briefing, supervision and review. So these are the factors which are not related to sampling. So these are the factors that basically non-sampling risk factors. Okay. So how can the non-sampling risk be minimized? It can be minimized through proper planning, assigning appropriate staff application, professional judgment, proper direction, supervision and review. So it can be minimized through proper planning. SA 300, if you plan properly, then non-sampling risk can be minimized. Assigning appropriate staff. Okay, so because of lack of training, or you're not assigning proper staff, so because of which non-sampling risk is increasing. So you can minimize it by assigning appropriate staff application. Next, professional judgment. You can enhance your professional judgment. You can properly direct, supervise and review. Okay, so this was about non-sampling risk. Now let us understand. So since we have read about the risk of middle misstatement के components, detection risk and detection risk components also, now let us understand. So audit risk is basically risk of middle misstatement and detection risk. Risk of middle misstatement consists of inherent risk and control risk. So detection risk also consists of sampling risk and non-sampling risk. So whatever assessment of risk is being done, it is a matter of professional judgment rather than a matter of capable precise measurement. Okay, so most of the time the auditor has to exercise his professional judgment. He cannot always precisely measure. Okay, so the assessment of risk is a matter of professional judgment rather than a matter of capable precise measurement. Now, so up until now we have completed the main components of audit risk, but now there is something left that is known as significant risk. So significant risks are nothing but the risks that require special audit consideration. Here, the auditor should determine whether any of the risk identified is significant risk. So after he has identified the risk, he will determine whether it is a significant risk or not. So in order to determine whether it is significant risk or not, he will use his professional judgment for such information determination. So what are the factors that auditor will consider? First, he will check whether the risk is a risk of fraud. If it is a risk of fraud, then it is a significant risk. He will check whether the risk is related to significant economic, accounting or other developments. Okay, if it is related to significant economic, accounting or other development, then it means that it is a significant risk. The complexity of transactions, for example, the risk that he has detected is involves complex transactions. So in that case, it is a significant risk. Risk involves significant transactions with related parties. So related party transactions, whatever risk is involved, that is also a significant risk. Degree of subjectivity in measurement of financial information related to the risk. And lastly, whether the risk involves significant transaction outside normal course of business. So if the risk is involving a significant transaction outside normal course of business, and if that significant transaction outside normal course of business is unusual, then also it is a significant risk. Okay, so these are all significant risks which require special audit consideration. So the auditor will use his professional judgment for determining such information. Now, how to identify a significant risk? See, significant risks are nothing but the inherent risk which have higher likelihood of occurrence and whose potential misstatement magnitude is also high. Significant risks are inherent risk whose likelihood of occurrence is high, whose potential misstatement magnitude is also high. And these mainly relate with non-routine transactions and judgmental matters. So basically, significant risks are the inherent risk that have higher likelihood of occurrence, that have higher magnitude of potential misstatement. Higher likelihood of occurrence means जिनके होने के chances ज़्यादा होते हैं. Higher magnitude of potential misstatement means इनसे होने वाली misstatement की size भी बहुत बड़ी होगी. Okay. So they often relate to two things: non-routine transactions and judgmental matters. Okay. So non-routine transactions means unusual because of the size and nature. It means that they occur infrequently. Judgmental include development of accounting estimate having measurement uncertainty. So judgmental means that you have to develop an accounting estimate. there is measurement uncertainty. So that it means judgmental. Okay, so always remember, two things are always considered as significant risk: fraud and significant transactions with related parties outside normal course of business. Two things always significant risk: fraud and significant transactions with related parties outside normal course of business. Okay, now what are the examples of the matters related to non-routine transactions? What are the examples of those? So significant non-routine transactions के case में the risk of middle misstatement is always high. Now what are the examples of non-routine transactions? Now the first one is greater management intervention. So management is intervening, okay, no problem, but management is intervening again and again. There's greater management intervention. So if there is greater management intervention in accounting treatments like revenue, sale of substantial machinery, then in that case it will be considered as a non-routine transaction. Now there is greater manual intervention. Manual intervention, okay, but in case of greater manual intervention, the data may be collected manually, leading to high chance of risk. So basically you are collecting the data manually, everything is manual, there is no electronic. For example, in these days what we are doing is that we are not maintaining manual books of accounts, we are maintaining through softwares like Tally, ERP, Zoho books. So if there is greater manual intervention, it means that the data is collected manually, leading to higher chance of risk. So manual compilation of data from branch for quarterly report is considered as a non-routine transaction. Okay, next, in case of complex calculations or accounting principles, so like in case of merger or acquisition, there are complex calculations and accounting principles involved. So those also will be considered as non-routine transactions. Merger and acquisition won't happen every day, so it is a non-routine transaction. Next, controls are difficult to be implemented on non-routine transactions. So remember that whatever controls are there, they are difficult to be implemented on non-routine transactions like merger, acquisition, or switching to IT systems. For example, you are following one IT system right now. If you want to switch to another IT system, the controls cannot be easily implemented on them. So controls are difficult to be implemented on non-routine transactions. Next, judgmental matters leading to significant risk. So in case of significant judgmental matters also, the risk of middle misstatement will be high. So always remember, risk of middle misstatement will be high in case of significant judgmental matters, and in case of significant non-routine transactions, the risk of middle misstatement will be high. Remember this point blindly. Okay, next, so what are the matters which lead to significant judgmental matters? Okay, what are the judgmental matters which lead to significant risk? See, judgmental matters का example है ये, judgmental matters which lead to significant risk. So for example, accounting principles subject to different interpretation. So there are certain accounting principles and they will be subject to different interpretation. For example, recognizing revenue for long-term contracts. So for short-term contract, the interpretation is different. For long-term contract, the interpretation is different. So the accounting principle can be subject to different interpretations. So अकाउंटिंग स्टैंडर्ड्स डिफरेंट तरीके से इंटरप्रेट किया जा सकता है कि रेवेन्यू को कैसे और कब रिकॉग्नाइज किया जाए. So this is one example of judgmental matter. The second example is the judgmental may be subjective or complex. For example, in case of future cash flow, if you want to future में हमारा इतना cash flow होगा, so this involves assumption. So it means that it involves judgment. Or in case of complex transactions, the judgment may be subjective in these cases and it can be complex, or it requires assumption about future events. So future events के लिए आपको assumption लेना पड़ेगा and sometimes it will be complex. So we are done with significant transactions as well, significant risk as well.